Welcome in, folks. 3 things to get into in this video and react to in this video here today. First one up here, Amazon, big position for me. Some of you guys might own that stock. Want to hear this analyst talking about what he is expecting for advertising business growth rates in Amazon overall. So looking forward to reacting to that little clip there. And then I want to react to this little clip, JP Morgan's top retail stock picks, okay? Then we're going to get into the core of this video, which is this article that was written yesterday that I'm looking forward to getting into. PayPal, wait for the Braintree moment. We haven't talked about PayPal in a little bit here, so I want to get into this article. Looking really forward to getting into that beast here today. Before we get into all that, I need everybody to make sure you are subscribed here to the channel. If you're not already subscribed, make sure you hit that subscribe button. We are at a new all-time high subscribers. I don't know the number, but I know it's an all-time high, and I appreciate each and every one of you for being here as always. Also, pin comment down there. We are now only 5 days away from the one-day massive sale we're having for that Patreon tier. You get access to my #1 course ever, access to see the moves I'm making and buys and sells each week, and access to that Discord chat, all for $69. That tier is usually $125. So if you want access to that, which you need access to that, we got over 1,000 members in there. That is going to be the pinned comment down there, okay? Pinned comment, enter in your info, and we'll send over that deal when it drops for that 24-hour sale. Let's get into this.
You know, I guess you think this spring sale has enough to sort of spring the stock a bit from here?
Well, I think every little bit helps, right? And then Amazon has been clearly one of the primary drivers, or one of the primary architects of shaping consumer behavior around promotions, et cetera. But I would actually step back and just look at the progression of the quarter. January was strong, February was stronger, and March, I think, maintained the momentum that we saw in March. So the Truist Card data indicates that the quarter should actually come out ahead, maybe $1 billion or $2 billion. And that's just on the marketplace. Wow. We think the AWS business is showing acceleration. Remember, it drops in Q2. And we think the advertising business is going to grow somewhere at twice the size or twice the rate of the broader advertising business. So we think it's going to grow somewhere between 25 and 30%. Digital advertising is growing at 10 to 15%.
Yeah, and advertising obviously very high in margin. I'm always curious though, what would give you pause here? You know, they can surprise us sometimes on quarters.
Am I expecting the company to beat revenues and earnings per share when they report their earnings in a couple weeks here? And the answer is absolutely. I'm expecting them to beat on revenues very nicely, probably by the minimum of $1 billion, but probably a couple billion, and then expecting them to smash EPS as well. And then that stock's going to go over 200.
When it comes to how much they choose to spend.
Yeah, I would say that's probably it. Certainly the AI race is heating up, and Amazon is not considered at the the top of that tier. You obviously have Alphabet, you have Microsoft, but Amazon is a clear contender, and you're going to see them continue to aggressively invest. The other area of big investment, which they're doing very quietly but very aggressively, is around building a global logistics network beyond what we already know with Amazon. They have this vision of being able to offer delivery to merchants, literally from the supplier in China all the way to people's doors. We think that they're basically taking a page out of the AWS playbook of offering logistics as a service. We think it's a $100 billion business, and that's good investment. We think, we'd love to see them invest more in that, because we think that's, again, a $100 billion opportunity that only Amazon is positioned to win.
Alibaba has a big business.
We started out talking about the e-commerce business, and the Piper Sandler survey that surveys teens twice a year came out today and shows us again that Amazon just continues to dominate teen market share. Really impressive numbers. 61%, basically, when they're asked where do they shop online, Amazon continues to be number one, but by 61%, and the second is Shein at 7%. I'm wondering how important it might be for an Amazon to grab a younger consumer's mind share, to keep them in this flywheel early on and then throughout their sort of spending life cycle.
I think it's super important. But remember, so by our math, Amazon already has about 43% or 44% market share of all U.S. e-commerce, and that cuts across all age groups. We think that obviously includes the younger audiences. What they're doing with Prime is really interesting. With the Prime subscription, they have different tiers, right? If you're a student, they'll give you a discount, a pretty substantial discount, et cetera. And that's to try to make sure to attract this younger audience. And the other is in terms of their ability to offer huge portfolio of products that cater to this audience. So we think it's a natural place. We don't think the Chinese e-commerce players have had any dent in Amazon, which frankly we feared coming out of last year, and that all bodes well for the business short term.
So, in terms of grabbing customers early on, right, and they speak about, obviously, teens using Amazon, those sorts of things. So my perspective on that is it important? Yes, but it's not as crazy as important as you might think. And it doesn't mean you have to stop competing for them. So let me give you a good example of when I was a teenager and where I shopped. When I was a teenager and I shopped, I went to Best Buy a lot. I went to places like GameStop, places like that, right? When's the last time I bought something from Best Buy? Probably 2 years ago, 3 years ago. When's the last time I went to GameStop? I don't even know. It was a long time ago, okay? So in regards to being a successful retailer, okay, if you have a teen shop in there, great, but you got to continue to put on for them and continue to keep them in your ecosystem, into their 20s, 30s, 40s, obviously, right? So you can't just grab them and think, okay, since they shop with us as a teen, like we're good forever, okay? You got to keep those folks in there. But there's no doubt there's a lot of folks going after the younger generation. Elf's another great example, right? They talk about Gen Alpha, in their conference calls even. And so, yeah, it's definitely an important thing, but it's you got to put on for decades, so.
An institutional investors retail Hall of Famer joins us now with this top pick. So American Eagle is really fascinating to me. For so many years, Matt, we put American Eagle and Abercrombie together as competitors. I think Abercrombie has really kind of changed its brand. I don't think it's really fair to call them a teen retailer. Abercrombie itself, maybe Hollister, the brand that they own. But American Eagle has really continued to hit on all cylinders. They did well through the pandemic. Their online is strong. Their store is strong. What's their secret sauce?
Yeah, thanks for having me on, first of all. And it's perfect timing. Off the heels of our 10th annual retail roundup, we had 30 companies in New York. The overall theme, I'd say, is twofold. One, the macro, and you were just talking about it, companies are talking about a stable U.S. consumer right now. And that's very different. As you know, we had supply chain congestion. We had 2 years of excess inventory. So companies are able to focus on innovation and investments to drive newness and differentiation. So I think what you're seeing is a real separation between winners and losers now going forward within this retail landscape. As you mentioned with Abercrombie as well as American Eagle and even with PVH, I would cite, there's two trends that I think have been building, but now really unlocking as we're seeing this point of stability. It's denim and it's active, but they both fit into this casual mega trend that I think fits into this post-pandemic era that I think the companies that can now invest in it, spend in it, which for us, what simultaneously is happening at American Eagle and PVH is self-help. So you're also finding companies can unlock efficiencies and have stronger bottom line profitability on actually the same, if not maybe just slightly greater top line run rates.
Very interesting. And I just spoke with Michelle Goss, the new CEO of Levi, and she's saying denim is really having a moment right now, to your point. Beyonce probably helping with the new Cowboy Carter album and even the song Levi's Jeans. I mean, when you look at a name like Levi, I know that's on your list. What are you liking about that beyond sort of the macro trend helping them?
So both of the prior trends that I cited, self-help on the margin front, they have found efficiencies and they've transformed their business into a much greater direct-to-consumer company. That's what Nike right now is on the next leg from an innovation perspective, but also, again, at the same time really focusing from a bottom line on profitability. So I think it's that, plus now you have this category opportunity and unlock as Michelle has taken over. But one of the things she's done is transform, or in early innings of transforming it, not just as a lifestyle brand, but from an overall backdrop of a denim lifestyle brand.
Oh, the music came out of nowhere. Okay, do any of those stocks, they were just talking about their PVH, Abercrombie, any of those type of stocks, are they interesting to me as potential stocks to buy? And the answer is absolutely not. Now, none of those sorts of stocks interest me. I don't like any of those type of retailers that are kind of trendy. They come and they go, and they're having a hot moment, and then they're crashing, and the margins are horrible, and then the margins are great. No. Okay, those type of companies, they come and go. Mall-based retailers, they come and go. And so, no, those just aren't ones that, there's too many other opportunities in the market. There's too many other great quality companies for the next 10, 20, 30 years to be messing around with those sorts of stocks. I can understand from a trading perspective, but no, okay. PayPal, wait for the Braintree moment. PayPal is one of the last remaining value opportunities in the tech sector. The company's growth is being challenged by competition, but its unbranded processing segment continues to grow very rapidly. Management continues to show a strong commitment to profitable growth and share repurchases. I expect Braintree to be the main catalyst for a meaningful re-rating higher. PayPal has offered investors a prolonged buying opportunity, which seems unusual given that tech stocks as a whole have been spiking without abandon. Yeah, it's been pretty crazy, and it's not like PayPal hasn't been growing their business. They've been growing their bottom line and their top line recently. So it has been pretty fascinating to watch this stock, not perform like some of these other stocks are performing despite putting up really good numbers, right? Management has issued conservative expectations for 2024 with hopes for stronger growth in 2025 and thereafter. The company still has a net cash balance sheet and profitable operations, but the lack of near-term catalysts may mean some investors, or may keep some investors away. Yeah, I don't know about, lack of near-term catalysts. I think a couple of the near-term catalysts are just them putting up nice growth rates, beating the guidance numbers they put out there, right? And that's going to get a whole new excitement around this. And I think as the quarters tick on, if Alex Chris and the management team can keep coming in and beating numbers, I think you're going to see more and more investors, and I'm talking big money, Wall Street, hedge funds, institutional money. I think you'll see more of that type of money start to flow into the stock as they get more confidence in Alex Chris, right? With the stock trading at low double-digit multiple of earnings, I cannot ignore the compelling value, as the low valuation and strong balance sheet have priced in a great deal of pessimism. I reiterate my strong buy, as I expect the rapidly growing Braintree business to eventually earn a premium multiple from this market. Yeah, what has really attracted me to PayPal? Was it let's say PayPal was trading at a 35 forward P. Am I attracted to PayPal? Probably not. Would this have been a stock I bought heavily? No. At a forward P of 12? It's a whole different story, right? I mean, one has such a low level of risk and such a high upside potential that it makes sense. If PayPal, let's say, is trading at a forward P of 40, it's not nearly as attractive, right? There's a lot of downside there. It's like, could I see PayPal going down 50% if they had a forward P of 40 on the stock? Sure, because then we'll put them kind of down to a forward P of 20, right? And obviously we're trading way below that right now. So this is where valuations matter. You can't just buy a stock because you like the stock or something like that. You got to really understand valuations on a high level, right? That's stuff we get into, obviously, in that Becoming Master of the Stock Market course. I get all into valuations, and obviously in the private group, I get ridiculously into all that stuff, right? That nitty-gritty stuff. Nowadays, there aren't many tech stocks that are trading far from their 52-week lows in 2021 highs, but PayPal is one of the few that still is around 2017 levels, yes, which just shows you how much pessimism there's really in this stock, right? I last covered PayPal in January, where I discussed the company's disappointing, shock-the-world results, but rated the stock a strong buy on account of low valuation. Hello, helicopter. Just do what you want. Fly your little chopper all around. I continue to find shares attractive, even if there's not a lot to be excited about in the near term. PayPal's key stock metrics. In its most recent quarter, PayPal generated 9% year-over-year revenue growth to over $8 billion, exceeding guidance for the year, up 8% year-over-year. Non-GAAP EPS grew 19% year-over-year and exceeded the guidance, right? So here he's showing the revenue numbers, right? Nice growth there. Transaction margin, which is, this is somewhere people look for weakness as far as what's going on in the company, and obviously non-GAAP numbers looking very, very good. The company has continued to show struggling active accounts growth, with growth coming in negative 2% year over year. That's another thing. If they can get growth going, get in the right direction, that's a whole other, growth vector for the stock price, right? Management blamed the poor growth on being reflective of churn of unengaged accounts, but it is hard to dispute the narrative that the company's first mover advantage in e-commerce checkout is being challenged by formidable competition from the likes of Apple Pay and others, right? No doubt, a lot of competition in this market, but once again, that competition is not new. Competition's been there. Apple Pay is not new. Apple Pay's been out for like a decade now, has it not? It's been a long time. Active accounts. So this is where they have not seen any growth, right? And so if they can get active accounts to get back to growth this year, I do believe that's a huge, area where the stock price would start going up considerably, because right now the main only negative things you can really say about PayPal is transaction margin dollars have been pretty stagnant and active accounts have been not good, right? Outside of that, you really can't say anything. You can't say anything about the valuation, the income statement, the balance sheet. I mean, those are really your only two things you got to go off of, right? TPV, total payment volume mix across PayPal payments. PayPal branded checkout up 6% fiscal year 2023, right? Unbranded, look at that growth, 30%. Then Venmo is at 9%, right? So clearly, Braintree is the massive growth vector for this company. The company generated $2.5 billion in free cash flow in the quarter, but that was positively impacted from offloading $1.7 billion of the buy now, pay later loan receivables, which de-risked the business, actually, big time there. I love that move. Adjusted free cash flow was $774 million, a decline of 46% year over year. The company ended the quarter with $6 billion in net cash, representing a bulletproof balance sheet, 100%. That's where I talk about the low levels of risk in this stock, right? When you talk about getting it for that sort of valuation, forward P of 12 or whatever, and then getting this sort of balance sheet with the profits that pour in, right? The cash flow that pours in, that takes so much risk out of a stock like this versus a lot of other stocks in the market, right? Looking ahead, management has guided for 6.5% year-over-year revenue growth versus consensus of 6.8%, and mid-single-digit non-GAAP EPS growth. Now, first off, in regards to this guidance, are they sandbagging? My opinion is, yes, they're sandbagging. Why would they sandbag? It's Alex Chris's first full year. This is going to be his first full year. He just got in the company like 2 quarters ago. This is going to be his first full year. Do you want to go in and say we're going to grow 10%, 11%? No. You want to sandbag a little bit. 6.5%, then come in, beat that number next quarter, beat it again the following quarter, beat it again, up your numbers for the full year, mid-year, right? And then beat it again in the fourth quarter. That's how you play this game. That's how you build trust. People starting to know you for beating your numbers and not missing your numbers, right? There's a big difference there. Guidance for Q1 2024, mid-single-digit growth on a non-GAAP basis. Non-GAAP effective tax rate, 19 to 20%. Revenue growth, 6.5% on a spot basis. And on an FX-neutral basis, 7%. For the full year, they're talking about at least $5 billion of share repurchase, which is going to help that EPS massively. As you take the insane amount of shares off the market, it's going to be big for that EPS, folks. Free cash flow, talking about approximately $5 billion. Non-GAAP EPS, they're talking about in line with the prior year, which was around 510. Management did note that they will begin including stock-based compensation in the calculation of non-GAAP EPS, addressing a typical bearish complaint. But I note that this adjustment is not reflected in the 5/10/2024 guidance, nor the 1/17/2024 Q1 guidance, as it will only be reflected beginning in the next quarter. As I have some investment analysis suggest otherwise. Make no mistake, management is guiding for earnings to remain flat on a year-over-year basis, which implies considerable margin deterioration given the ongoing revenue growth and share repurchase program. Once again, I think they're sandbagging. We'll see as the year shakes out, but I think they're sandbagging. On the conference call, management explained that the decision to begin including equity-based compensation in non-GAAP EPS is aimed to introduce more accountability and discipline. I like it. It doesn't make the 2024 numbers as exciting if you're going to be more truthful than the company's been in the past, but I like it, okay? As somebody that wants to be a shareholder of companies for years and years and years, I'd rather my management team be much more accountable and disciplined and truthful, right? Management emphasized that they are committed to maintaining an investment-grade credit rating and aim to spend approximately 70% to 80% of our free cash flow on share buybacks. This might imply around $3.5 to $4 billion in 2024 share repurchases, but management notes that due to the strong cash position, they intend to repurchase at least $5 billion. At least $5 billion. All things considered, management appears to be saying all the right things, and this is a playbook that has worked for other companies heading into this tech rally. Meta Platforms comes to mind. I have talked about that one many times, obviously, right? It's my number one position in the public count, up 300+% on it now. Could we see PayPal up 300% for me in a few years? It's possible. We'll see. But when investors reward PayPal with a similar treatment, if ever, good question. Is PayPal stock a buy or hold or sell? It's easy to forget, but PayPal is one of the pioneers in enabling e-commerce transaction. While the company is most well known for its branded checkout and Venmo app, I instead draw your attention to the unbranded Braintree product that's been growing rapidly. So let's see, what do they have here? Well, here they had the forward P of the stock, right, trading at 12 times, which is just insane, absolutely insane. They have the revenue growth expectations there about 7 to 8% over these coming years. Well, I can make an argument that Adyen may be higher quality business due to its stronger overall growth rates. It is really worth 39 times 2024 estimated EBITDA when PayPal trades at 9 times 2024 estimated EBITDA. Good point. That is pricing in nearly 6 years of 30% growth just to narrow the gap. But that is also assuming no growth from PayPal, which seems unlikely, 100%. I continue to see PayPal eventually trading at a 15 to 18 times earnings. I think a 20 to 22 would be much more fair for the stock, in my personal opinion. When you look at the growth rates, if you can grow your revenue 7 to 8% a year, right, and let's say you grow your bottom line at a little bit of a faster clip than that, let's call it 9 to 10%, the right valuation for you is kind of in the 20 to 22 range, in my opinion. But the catalyst to drive this re-rating may be elusive. Yes, the company's commitment to profitable growth and share repurchases may help over the long term, but these are unlikely to spur near-term reaction. Instead, I expect continued growth from the unbranded processing to end up being the catalyst. As Braintree becomes a bigger and bigger portion of the business, I expect Wall Street to reward PayPal stock with a higher multiple as it realizes the profitability can continue and improve alongside the growth. And you know what's something very, very important that no one's factoring in this whole Braintree situation? No one's factoring this in. And I'm like, this is something I can't believe more people don't talk about. With the Braintree side, right? That side of the business is going to be ridiculously sticky. Ridiculously sticky. Once they get in the door with a big e-commerce company or an app or whatever, right? It's going to be very sticky. And for then somebody to move off of Braintree, once they're starting to use Braintree and then they start using it for more and more of the options that Braintree allows you to do to manage your back end of your financials and your business and things like that, I think it's going to be extremely unlikely that folks then say, you know what, let's go ahead and replace Braintree with something else, right? Consumers many times can use one app one moment, then switch to another, then switch to another. Consumers can be sometimes a little more fickle. Big companies, once they use something and it works, they don't want to switch off that. They want to stay on that product. The only way you can get them to switch is if you do a bad job for them. And from my understanding, Braintree does a great job for all their customers. So unless Braintree screws up things for their customers, people are just going to continue to use it. It's just like, it's the peace of mind. Even if somebody said, you know, hey, we can save you a little bit of money by doing this, you'd be like, nah, I'm not interested because this works flawlessly. I don't want any issues. You just kind of get stuck in the ecosystem, right? What are the key risks? The company's branded checkout processing is under heavy competitive pressure, or at least that is what sentiment dictates. It bears noting that PayPal branded processing total payment volume grew by 5% year over year, though that might not be as important as a fear of ongoing disruption. The company, the branded processing, right? So that's different than the unbranded, the obviously Braintree side. The company may need to show stabilizing results in its branded processing and acceleration in overall top-line growth rates as a result from the continued stellar results from the unbranded processing. Before re-rating occurs, this is no easy task and investors might need to be patient. It is possible that the macroeconomic environment worsens or that branded processing volumes growth deteriorates further simply due to competition. It is also possible that unbranded processing growth slows down and the company's strong growth over the past few years proves transitory. I can see the stock trading between 8 times and 12 times earnings until re-rating thesis takes place. I personally am not concerned with the volatility given the strong balance sheet and confidence in the long-term thesis, but investors hoping for a quick trade might be disappointed. I reiterate my strong buy rating for the stock, and the valuation looks particularly compelling when compared against lofty valuations for other tech stocks as a whole, right? So, first off, in regards to, I mean, the stock's up high. It's just like the risk reward is too dang compelling in regards to PayPal, right? It's too compelling. 12 times this year's expected earnings with his massive share buyback on, a guide. Even if I think about, let's not even think about the next 5 years. Even let's just think about this year, okay? Is PayPal risky this year? Probably not getting a recession this year. It's potential, but probably not, right? Next year, the year after, well, could be a whole totally different. Probably not getting it this year. So that kind of takes that out of it, right? Is the Fed likely to go higher on rates this year? Probably not, right? So we got 2 probably nots already out of the way, right? Next up. Do they have insanely high numbers to hit this year? No. So they're probably going to beat their numbers throughout the year, right? Stocks trading at a very low valuation. You've got so many of the boogeymen out of the way. And if Alex Chriss can put up those numbers, it's going to convince more and more people to say, hey, you know what? PayPal's a great company. It's got several compelling businesses. I got to be part of this. Now, on top of that, if active accounts can grow, then you take that boogeyman out of the market of like declining active accounts, right? So if we can get that boogeyman out as well, you got really nothing left at that point in time, right? So now the last thing I'll say here is a lot of people, get focused around the stock price. They want the stock price up in the short term, right? They want to see the stock back at $80, $100, $120 very quickly here. Here's why you shouldn't want that. You shouldn't want that. If you're planning on being in the stock for the next 3-5 years, you shouldn't want that. And here's why. Right now, as we spoke about, they're doing that massive share repurchase, right? Guess what? They can get a lot more shares at $65 than if they were doing the buyback at $85 or $105 or $125, right? And so if you're really thinking about the stock and rooting for the stock over the next 3 to 5 years, you should want the stock to stay under $70 for as long as we can here in the short term while they're buying back all these shares, right? So that's just a little more food for thought. And then the last thing I'll say here is if the stock starts to move, let's say active accounts, they stabilize at, and maybe that gets back to slight growth, revenue comes in and beats, EPS comes in and beats, good conference calls, all those sorts of things. Imagine all that plays out while the company's got a big buyback going on. Oh boy, because then you're talking about big money's going to be flooding into PayPal stock. Simultaneously, you're going to have the company buying a ton of shares, and it's going to create this environment. And anybody that wanted to sell the stock has already sold it over the past 3 years, right? You can't get the stock to go any lower, really, in the short term. Anytime it goes lower, it gets bought right back up. So then you just have a ridiculous amount of buying pressure on the stock for like a 12 to 24 month span, which creates a very interesting dynamic for the stock price to go, to appreciate considerably, right? And next thing you know, all of a sudden PayPal's $100, $120, $150, and it happens pretty quick. So you kind of want to root for it to be lower here in the short term, but I'm not so convinced the stock's going to be lower in the short term. Obviously, you know how I feel about the next 3 to 5 years with PayPal, but even this year, if I had to guess, is PayPal $60 at the end of the year or $100 at the end of the year? I would go much with 100 over 60, okay? All right, guys, appreciate you joining me. Much love as always. Hope you enjoyed today's video. Smash a like and a subscribe. And also, one-day tax break sale, 5 days away. Pin comment down there for access to that. Enter your info. We'll send over the deal as soon as that drops 5 days from now. Much love and have a great day.